It's Saturday morning, May 5th here. I'm going to fly through some charts this morning and update on what's going on a few different markets here. We're going to look at stocks, we're going to look at oil, going to look at the US dollar. I want to look at several time frames on stocks. This is the S&P 500. It's a monthly chart time frame, so each one of these candlesticks is 1 month. This is the bull market high from 2007, bull market low, and where we are currently. And if you look at the stochastics under here, stochastics is overbought and is just starting to cross down. In fact, the percent K did just cross down as of the last day or so underneath the percent D. So we have a potentially overbought market. And if you look at the levels of the stochastics, there's a slight bearish divergence between this high here and this high here on the stochastics. It did not reach a new high there, so that's potentially a longer term bearish implication on the stochastics. But in any case, we could be overbought, possibly turning down on a monthly time frame. Now, if let's go over to the weekly time frame here. This is the S&P 500 on a weekly time frame. This is the May 2011 high, October 4th low, and on up to where we are now. This is the stochastics up here. So what we're seeing here is, as of the last really 4 weeks, we've turned down in the weekly stochastic. So we have momentum trending down on that right now, just coming out of overbought territory. And this is the MACD below that, and as of this week, it just crossed into a sell signal on the MACD. The last time we saw that was mid-March, and then it still had a little bit of work to do before it topped. But in any case, we're having some signals shifting towards the downside in the technical analysis there. This is the S&P 500. This is a daily chart. This ADX indicator down here. We saw a nice trending move down into August here. The market went through a long consolidation chopping phase, had a nice trending move up in here to February, and then the ADX has been falling, which means it's been going back towards a trendless phase, and we're at a very, very low ADX level, meaning we've had some chop over the last couple months. So potentially we're set up for a new trend here, either up or down. But if this starts to turn back up above 20, whatever direction price is going, that's potentially a new trend there. One more thing looking at in this chart shows the 50 and 200 day moving averages. The 50s in blue here. The S&P 500 broke through the 50-day moving average on April 10th, and then it's chopped around that, poked above that, and then broke down pretty hard below that again on Friday. A lot of times you'll see some chop around those significant moving averages, whether it's the 50 or the 200 here. So at this point, as long as it stays below the 50-day moving average, that would be bearish. Program traders will sometimes use those moving averages. I think that's why you see a lot of action around them, is they're just built into the trading systems that institutions use. This is the Dow 30, and the Dow actually made a new high. It was the only major index to make a new high here this past week. So it poked above the March and April highs. But if you look at the MACD down here, there's a pretty sharp bearish divergence, and then it immediately failed after trying to break out on Tuesday. It immediately closed back below. It actually touched the upper Bollinger Band, closed back below the lower Bollinger Band, closed back below the highs of April, and now it's sold off some there, and we're close to a daily sell signal on the MACD. It's right above this rising trend line here, so next week could be a breakdown week below that trend line there. So Russell 2000, this is a weekly chart. You can look at the weekly chart. The stochastics, the momentum is trending down, and it's right around neutral right now. It looks like it has about a minimum of probably 3 more weeks before the stochastics may be close to oversold. Probably 4 weeks before it could really be down in oversold territory. So by that measure, we could see another month or so of downward trending type of move in the stock indexes. I switched over to a daily time frame here on the Russell. Potentially there's a little bit of a shoulder, head, and shoulder type of pattern here. These lines right here is a very, very tight harmonic resistance zone, which I didn't show in detail on the I think on a recent post, but I had mentioned. But the market touched that, reversed on it, has now come down, filled, and closed below this large gap up from a couple weeks ago. We're right near the support level down here on a potential neckline. The daily stochastics momentum is also down. So we have daily down, we have weekly down, we have monthly overbought starting to turn down, and then I'll look at let's click over to the hourly chart on, this is the S&P 500. The MACD momentum is still down but getting close to oversold. The stochastics is oversold. So, but there is no divergence on this yet. So in a downtrending type of move, a lot of times you'll, at a bare minimum, see a nice divergence on the hourly stochastics before a rebound, and in a downtrend on any significant move down, multi-day move down, a lot of times you're going to see actually some nice bullish divergence in the MACD before you get a rebound here. So I think based off the candlestick closing at the low, and based off of no divergence on these, I think we'll see lower lows early next week in the markets, probably taking out these April lows. Now, these lines here on the S&P 500 is just showing the time from this low to this high. And the logic here is that if the market retraces from this high below that low, so traces back below these levels, in less time than that took to form, or less time than that took to happen, there would be a logical shift in the power of the market to downside. And in fact, if you look at this, the market has moved down from early April, moved down for a week and a half, and then it took a few weeks to even retrace partial of that move, and it didn't get the whole way above it. So we have kind of a channeling move here, but it seems like the logic or the price momentum is shifting to the downside as far as where the power is. So if we see these lows broken by Wednesday's close this coming week, that'll be further confirmation that we're experiencing an intermediate term correction here at a minimum. This New York Stock Exchange looks pretty much similar here. For those who follow Investors Business Daily type of methodologies, looking at distribution days, you can go back through the S&P 500 or the New York Stock Exchange. There's been probably 6 or more distribution days since the April highs through here, so without making a new high. So by that token, the institutions are putting in some heavier volume selling days here, and there's some other ways to measure that too, but pretty much any way you look at it right now, institutions are in a moderate level of distribution right now. This is the Nasdaq. Let me click out here. This is the 2007 bull market high. This was the May 2011 high in the Nasdaq. I have a kind of support resistance level there. The market is still above that line. That's this black line here right now. Market came down and filled this large gap up from a week or so ago. I think it'll be interesting to see how it responds, the market responds as it comes back into this support level and this upper trending line here. So there may be some support here. So maybe we see the market break down into those levels and then rebound, and then we'll have to see what happens from there. One thing I did want to note, and I'll show this on another chart here, if you look at these red lines here, those are some trend lines on the RSI, and oftentimes what you have is if you have an extended leg up and you draw a trend line on the major first few lows of the trend, at some point the market's going to start to weaken and really break that trend, but the RSI will then come up and back test from the underside of that trend line as it's making its final high and be ready to break down. And we've really seen that here from the August to the October, November, March lows. We have a rising RSI trend line. It broke that here on the initial April decline. We've come up and just back tested that. So if we break down below these price lows, that would be a nice short type of setup on the RSI there. this shows some similar trend lines on this is the SPY ETF, so the S&P 500 shows a similar RSI trend line on that with a nice back test from the underside. You can see the same thing happen back here as it came up into the April and May highs. This is a simple momentum indicator. Again, it's broken through the trend lines from August to November, has been hanging below that, put in a little retest on the underside of that. So this could be a breakaway point to the downside here. If you look at the S&P 500, this is the May and the July highs. The market has basically created a support level between that high, and this low here. So if it comes down to this low and breaks through it, that could be a bearish chart signal in that it's not holding, it's failing to hold those highs, and that may even be considered a double top type of a formation if we look at this as the first top, this as the bottom, this as the second top. However, that would still have a lot of work to be done to actually complete a major double top pattern, but at least for the short term, it could be viewed as that. One thing I did want to mention, I've followed Apple pretty closely here over the last several months, just looking, kind of gauging where the market is based on what happens with Apple. And I've showed this in detail before, but this red line here is kind of an upper channeling line between the highs of this bull market move in Apple, and we saw it break through that level in February, and it came back down and touched that level right here the day before earnings were released after the close on that day that it touched that line. Then it gapped up, and now it's pulled right back and essentially filled that gap and is just above that line. If the market closes back below that, that's potentially a bearish signal. The market has also closed below this potential trend line here, and it did gap down and then close below that, so that's a bearish signal as far as that goes. This line here is a longer term support resistance line, so there is some potential support and resistance right here, but if the market comes down below those lines, we may see a very major correction in Apple. One thing I did want to note here that I think is significant, this gap up that just happened last week on Apple's earnings, it gapped up 10% on earnings, and that was actually the biggest gap up in this bull market in Apple. So if you go all the way back to March of 2009 when the markets were putting in the lows, and you follow price up through here, there were a few decent sized gaps at a few areas in here, but this is the largest gap. Now, large gaps off of potentially major lows are often breakaway type of signals. They're often very bullish. Large gaps right at new highs, or large gaps up to new highs that break through a support level, kind of like that one, are oftentimes also very bullish. However, if anybody's familiar with exhaustion type of moves, if you see the largest gap in an entire trend at the end of the trend when the market's overbought or after the market's starting to weaken, those can be exhaustion gaps. So news came out, earnings were great, as they always are, had the biggest gap up of the entire move. Obviously a lot of excitement on that, but there's no follow through to the upside. It didn't make a new high. It's immediately coming down and filling the gap. So there's just some signs here that this may be a psychological indication that, okay, there's a gap up, the news came out, and since then the institutions are just selling that. They're not really interested in buying that news. They're interested in selling that news. So in any case, that could be a longer term bearish signal, but that is yet to be seen on that. This is the USO ETF, the oil ETF here. I mentioned this on the blog yesterday, and I've talked about this before. There's been indication for the last several months that the smart money has been record net short on this, and that at some point it's going to force prices to decline as the speculative buying comes out of this. And I talked about a setup similar to the one right now that is happening back here in February, which did not pan out. So what we saw is the Bollinger Band squeezing, the market approaching the low, market gap down below the Bollinger Band, but the market did not make a low close, and then it immediately closed right back above the Bollinger Band. What we have here is a tight market squeeze. The market had a large gap down and a low close way outside the lower Bollinger Band. The bands are both expanding. I don't have the ADX pulled up on this chart, but the ADX has been in a trendless mode below the 20 level for about the last 6 weeks since mid-March here. So these, after an extended consolidation period where you have a low ADX reading and then you have a tightening of price movement. So the last month, all we've seen price move is just in a very tight range between 38 and 40 essentially, and then all of a sudden, boom, you have this big breakout move here. Oftentimes they lead to very sharp moves, but they can be relatively short-lived. The next support level here would be the December low in oil. Just on this type of setup, I think we could be there Monday or Tuesday. I think it's very possible that the market gaps down again and almost immediately comes down to that level. Longer term, I don't know how many days we'll see the market continue to hug or go below this lower Bollinger Band before snapping back, but these can make some powerful type of moves here. We saw an incredible one in silver back in September of this past fall, and so we may see a big gap down again on Monday. We may see another large move down on that. So that's something to watch here, based off of what the smart money is doing here, based off of the longer term implications. I believe this move is going to come down and go below the October lows, possibly much lower than that on a longer term basis. But this is a pretty clear signal of a break of this trend line with a large gap, break out of the Bollinger Band level, extended consolidation basing period. That this is setting up for a trend downwards in oil right now. Let me show you this chart here. This is a oil holders ETF, and a lot of oil stocks are showing a similar pattern here, which is basically a ABC type of zigzag move down off the July highs, and then a pretty picture perfect triangle, symmetrical triangle forming off the October fourth low, like an A, B, C, D, E. And what we saw in this particular ETF was this B to D trend line. There was a large gap down and a close below the trend line on Friday there, so this triangle may very well be complete. The implication would be, at a bare minimum, for a move back below the beginning of the triangle, so it moved back below the October lows. Some of the rules of thumb, or you want to see a move at least, you should expect to see a move at least 3/4 of the length of the A wave, but you should also at minimum see it go below the A wave. So I know the traditional textbook move for a triangle is take the prior move down. So you would take this move here, and then you would project that down from the breakout point of the triangle. So if we took that down from the breakout point of the triangle, that's a pretty major move down. That would say, by next summer, or excuse me, by middle of this summer, we could see the market, 30-40% lower from these levels. So we'll see how that plays out, but that is a pretty textbook looking triangular type of pattern there, so keep an eye on that. This may be a very good time to initiate an option trade, either at the money or slightly out of the money. You could use a close back above there as a stop level, where you say, okay, I'm going to buy September puts on the ETF, maybe buy the 40 puts or something to that effect. That's the gap or breakaway point. And you basically, you can either just risk the whole amount, and if it fails, you lose the whole trade. But you could also say that logically the market should not come back above this level. So if for whatever reason it does, you'll just exit, take whatever value is left in the option at that point. So you could save yourself from having a entire loss if the market does that. But I think there's a good chance, based off of the underlying oil contracts, that you're going to see some pretty significant moves down in these oil ETFs there. The last thing I want to show this morning is the US dollar euro relationship, and there is a relatively nice triangle. This is the euro US dollar currency exchange. There's a nice triangular type of consolidating pattern happening here, and I believe this may be something to the effect of a WXY type of pattern here. So it's actually not a downward triangle with a continuation move up. I believe this may be ending a complex upwards phase here. What we did see is the stochastics on the daily chart turn down into a sell below these resistance lines here and below this old high. These dotted lines basically represent that if the market closes below this low by May 16th, so by the Wednesday prior to option expiration, that there's price logic confirmation that the downside power, the power in the market is to the downside, and that this move up is being retraced faster than it took to form. Breaking below that support line there would also be a sign that we may have completed a triangle, and the textbook projection on that would be for the widest leg of the triangle projected from the breakout point, which would put us a little below the January lows in the euro there. All those would tend to correlate with downward stock prices and downward commodity prices there. I think it'll be interesting to see how gold reacts if that happens, but in any case, I think we're moving into a downside phase for the next few weeks in the market here. So that's all for this weekend update. I don't know that I'll get into anything else this weekend, but I would say that next week we could potentially see a continuation of the downside move in a lot of these markets. Have a great weekend.